We start today's market talk. The person that turns over the most rocks wins the game. This is what Peter Lynch said. You should always be hunting for new ideas as it gives better results. Best time to look is when nobody else is looking. Market outlook. The real GDP growth for India came at 6.7% in Q1 FY25. The gross value added GVA in Q1 is much higher at 6.8%. This is slightly lower than 7.1% penciled by MPC, but GVA is higher. GDP is GVA plus product taxes like VAT minus product subsidies. Now, private consumption has shown year-on-year growth of 7.5%, which is a welcome change from tepid growth in the earlier quarters. It shows that consumption is finally trickling down to the masses and is becoming more broad-based. Despite fears of slowdown in capex, etc., the gross fixed capital formation growth was 7.5% in Q1 FY25. So, which indicates that the private capex is picking up. Previous quarter, it was 6.5%. GDP has been pulled down due to lower net exports of goods and services and lower government expenditure, while growth in agriculture, construction, trade, transportation, communication, etc. has picked up. These sectors actually provide jobs and is good for growth of consumer demand. Manufacturing slowed, but since the base is high, it is not a concern. Monsoon is relatively good, which should keep inflation in check, thereby aiding consumption demand. Rate cut in US could be the catalyst for emerging markets. US GDP growth came at 3% in June quarter. It is good and it is slightly better than estimates. Consumption spending was 2.9%, indicates US economy is far from weak. It should reinforce the soft landing narrative. Major central bankers, except Bank of Japan, are now focusing on softness in labor markets instead of inflation. The rate cut is positive whenever it takes place over a period of time because the interest rate and growth differentials help the fund flows to emerging markets. Huge amount of domestic liquidity already sloshing around in the Indian markets reflected in IPO subscriptions. If FPI inflows into India turn net positive, it will add to huge amount of domestic liquidity. Premier Energies IPO of 2830 crore got a bid of 1.48 lakh crore. So you can imagine the roughly 50 plus times of subscription. You can imagine the kind of euphoria which is there. LG Electronics has become the second South Korean company after Hyundai Motors to announce plans for a listing on Indian stock market. LG is the largest home appliance seller in India, while Hyundai has localized and customized its products for Indian markets. For example, Santro, Creta, i10, i20, etc. LG is the largest producer of TVs, ACs, and washing machine. Now, near-term outlook appears to be soft for commodities as China's economic recovery is not helping. The uneven economic recovery in in China, basically better exports but lower internal consumption and lower real estate market may lead to rising stocks of steel making raw material like iron ore and non-ferrous metals, so which will lower the prices. Copper prices have come off already due to marginal surplus and soft demand. A weak price trend for steel making raw material also signals a weakish outlook for steel prices. So it is near-term negative for commodities and it is also reflected in the crude prices. Now, weekly statistics, if you want to see it, Nifty was lower. Sorry, Nifty was strong. It was up 1.66%, but the bank Nifty was lower, just rose 0.82%. Gold corrected, silver also correct because of strong dollar. Crude oil was also down because of lack of demand. Natural gas prices were up. It is because there is a season of a cold season is coming in the uh, Western Hemisphere, which will lead to higher prices for gas. Hence, people are already building positions, and this is basically because of cost of carry. Dollar, as I told you, was stronger as it rebounded from oversold levels. USD INR was at the same level when the 10 India's 10-year bond yield. NSE market cap was slightly up. Market-wide positions went down because of the expiry, and now let's see how the fresh positions are built. Uh, Dow Jones was up around 0.9%. Nasdaq was down due to Nvidia, and S&P 500 was also generally flat. Now coming to US, indices closed the month in positive territory considering the plunge at beginning of the month. Nvidia results were good but still failed to keep lofty expectations uh, as per them. It slumped 7% uh, on Wednesday. So if you see here, US 10-year yields corrected uh, are in a corrective trajectory, but it rose last week because the economy strength is strong. The dollar index has been correcting and it had reached that demand zone. So from here, since it had become oversold, it bounced back. Earlier also, it had bounced from this 1999.5 level. So it bounced back from here. Let's see what is the future trajectory. But as it is also making lower highs and lower lows, it is expected to go down to around 95, 96 level. Brent crude corrected and it's in a downward trajectory because of low demand and lack of any negative triggers. Gold was up just because dollar was mm, dollar went up. So gold had a small 0.36% fall last week, but it has not corrected much and it will remain generally at these levels till US elections are sorted out. And I think the major rally we will see after the rate cuts take place in 2025. Copper has taken support at its 100 EMA after it had corrected from there. This is a weekly chart. So still this gap has to be filled. Let's see how the prices move from here. Right now, there is adequate stock of copper, so there is no deficiency as such. Nasdaq has bounced back from the lows of August and is now trading at higher levels than uh, August levels, though it corrected last week, but it is above this rising trend line and is above the moving averages. India VIX slightly declined and it is trending downwards because there is now slightly lack fear in this market is slightly going down with most of the events having played out. Government bond yields are at generally 6.86 level. So they will require now a major trigger to move in either direction. Otherwise, they will generally remain at these levels. Nifty, if you see the weekly charts, it gained on all days and made a large botted bullish candle on weekly charts. Outlook is positive and it has made a fresh all-time high. This is a daily chart. So if you see here, hit a fresh high, made a kind of a doji on Friday because of various events and events related to Reliance results, etc. But there's nothing to fear about out here. So it is heading higher and it has filled all the gap which was there. This is the hourly chart of Nifty. If you see from the lows of August 5th, it has constantly gone up and now it is trading above the 20 EMA of the hourly charts. Till the time it is above 20 EMA in the hourly charts, it is positive. The next support will come at around 25,000 level, which should, where it took support last week. And this resistance will now provide support subsequently. So This should be important level to be watched at, which is the 50 hourly moving average also. Now, Nifty Bank saw a rally uh, due to gap openings throughout the week and also because of expiry week volatility. Small botted bullish candle on weekly charts was seen. On the daily charts, if you see here, it has gone above the gap here, and now it is trading above there. So it is now forming a bullish pattern. And if you see on hourly chart, it has making a rising triangle pattern from the lows here, and it is giving bullish signals and hoping for a breakout. It is above the 20-hour moving averages, so it is positive. Now, among the banking stock, the stock which is looking strong is ICICI Bank. It has on the weekly chart, it bounced from the 20 EMA and is making a kind of a rounding bottom and heading may test its last all-time high and make fresh highs if this momentum continues. HDFC Bank is consolidating and looking slightly weak, though it is above the 20 EMA. So it bounced from there due to this uh, likely inclusion or likely MSCI fund which is coming in, but then it corrected at end of the day. So it is stuck at these levels. So till the time it is above 1600, it is positive, and uh, we should not go short on this below till it is above 1630. Reliance, it went into after the AGM, it corrected. It went into this supply zone, the gap which is here, and it corrected from there. But the support is at this level of 2050 EMA, which is closer to 3000. So till 3000 holds, one can go long here. So it has tried to go through this gap twice. Maybe third time it may be lucky, get through this. It was trading with high volumes on the last two trading days. Mazagon dock has corrected from its high it had made, and it is now below the 50 EMA and has retraced roughly more than 38.2%. So it can test that's 50% retracement area, which coincides with 100 EMA also at 3970. So if this level breaks, then it will correct further more and test the 200 EMA. So watch out for this. Uh, and once it reaches these levels, it will become oversold also. So there is a possibility of uh, short bounce back also. But if you see the Elliott wave theory part, now this is the first wave where it made a rise from this 1000 odd levels. And after that, this is a corrective phase, wave two, which is on. Let's see where this wave two finishes after the retracement as per Fibonacci is over, and then the wave three starts. The index which is looking strong is Nifty IT. It made a cup and handle and has broken out from there. And despite this weakness in beginning of August, it has it has not breached the 20 EMA on the weekly chart and has now made fresh all-time high. And this is one sector which is looking very bullish. Midcap index has made a fresh high, and now the uptrend continues. It has constantly traded above the 20 EMA, and once midcap start moving up, then the broader markets also perform. Same thing with small cap index, again making a fresh high and above the 4th June level. So it is also looking pretty strong. Now I'll cover three stocks today. First is HCL Tech. Discretionary spending is improving versus last year. BFSI is seeing demand revival. High growth areas identified by management include data analytics and AI, SAP migration opportunities, SAP is systems, application, and products in data processing, technology, media, and telecommunication, cloud, and ER&D. Focus on extracting efficiencies to fund growth through initiatives such as transforming delivery with generative AI, optimizing entry-level fresher deployment, enhancing utilization with AI-driven learning, capitalizing on increased client acceptance for shifting operations to new cities in India. AI-led efficiency gains, it could boost software development efficiency by 10 to 30%, focus on enhancing pricing, contracting solutions, and relationships to secure large deals, have recently executed three mega deals, including one valued at $2 billion and two over $50 million, and earned recognition in Gartner Peer Insights. IT services are expected to maintain double-digit growth over the next 5 years with improved market participation. So coming to their income statement, uh, in terms of revenue, they are expected to do 10% revenue growth over the next FY26 and 27. After this present year is over, the expectations are that they will get fresh orders. The margins are also going to be better, 22 plus, and likely to hold. So there is no cost cutting, etc., which is happening. As such, EBITDA is also going to go up around 10 to 11%, etc. Similarly, all the margins, etc., are expected. Net profit is also expected to grow at around 10%. So it is positive. They are expected to do around 71 rupees EPS in FY26. So, and with they are giving around 80 to 90% dividend. So it's a positive thing, giving around 4-5% dividend yield stock, and all the return ratios, turnover ratios, liquidity ratios, valuations, etc., are positive. It can easily go to 25, 26 times, so which is 1800 to 1850 level, based on the FI 26 earnings. So if you see here, the in terms of dollar revenues, it is expected to show a growth of for FY26 and 27, expected to grow of around 9-10%, with constant currency growth also at the same level, keeping the dollar value at 84. But in case the dollar appreciates versus the rupee, then this earnings will improve. But this is positive, and constant currency growth of double-digit constant currency growth is very good. Let's see the chart. It has already reached 1750 level in this uptrend. It was at around 1300 to 3 months back, and it has gone up due to good performance and good management commentary. Right now, it is slightly overbought, but it is a buy at every dip from here. The key issue is, in terms of all IT stocks, discretionary spending is improving, and IT services should provide double-digit opportunity over the next 5 years. Next stock which I'll cover today is Godawari Power and Ispat Limited. It's a fully integrated steel company that operates across the entire value chain. The company's operations include mining iron ore from its two mines, producing iron ore pellets, and manufacturing high-value steel products. Products manufactured are pellets, sponge iron, iron and steel billets, wire rods, hard black wires, and aero alloys. Iron ore is converted to pellets, which are oval lumps of iron ore that are hardened using fuel and used to make steel. Now their pellets manufactured are of high grade and earn a premium of 1000 to 1500 per ton over the market price. Despite weakness in prices, iron ore market remains largely balanced. The rising revenue from pellets, 57% is expected in FY27 versus 38% now, and captive solar power plant and backward integration for galvanized products are the other factors for margin expansion. It will pursue CapEx to be an ideal steel manufacturing company with finished steel capacity of 2.5 million tons, producing wire rods, HRC, and CRC, which will be fully backward integrated on iron ore and driven by green captive power, so reducing the cost. Captive iron ore plus increasing contribution from pellets will result in rising profitability. It is lowest cost iron ore producer as it does not have to pay any premium on its iron ore, and they are trying to do rolling mill modifications for galvanized products. So what they are trying to do is they will use in-house billets, which will be converted to galvanized products and which will help in their margins. Now, coming to their assets, if you see here, they're majorly in Chhattisgarh. So they have two mines, Ari Dongri iron ore captive mine and Boria Tibu iron ore mine, uh, with with roughly around 3 million metric tons per million tons per annum capacity per year. They have other plants in Chhattisgarh and a pelletization plant in Odisha for their subsidiary called Ardent Steel. They are creating all these solar plants and etc. at various places in Chhattisgarh for green energy. So they are growing in these areas. Now let's see their mines. They have mines leased till 2050 with no premium over royalty paid, and it benefits spreads. Now let's see the uh, NMDC, the costing for NMDC, considering balance issues are the same, that is royalty, etc. NMDC pays a premium at 22.5% over all these costs. So it comes to 1082 rupees. Hence, the landed cost for iron ore for NMDC comes to 3915 rupees per ton. The auction mines which have gone to other players, the landed cost comes at around double of that at 8121 due to high premium, which is 110% over these prices, over the prices. But for GPIL, if you keep the IBM price same, still, since they have no premium, their landed cost of iron ore comes for them to around 2834 rupees per ton. So, which is pretty positive and which gives them a huge benefit in spreads. Now, they make best in industry profits on pellets due to high grade. Their pellets have good iron ore content, roughly 63 to 67%, and fully captive iron ore mine. So as we have seen, market price of iron ore has been increasing, which helps because the captive iron ore landed cost, as I brought out, is 2800 rupees per ton for them. So if you see overall total iron ore cost for merchant pellet producers, cost of conversion to pallets. So cost of pellet to GPIL is 5,100 rupees, and cost of pellet similarly to merchant pellet producer is 8,800 rupees. So they have a straight pay advantage of 3,700 rupees in cost of pellet. Market price as per steel mint is 9,585 rupees, while they get premium of around 1,000 rupees because of better quality of pellets. So EBITDA per ton is 5,500 rupees, while for the other merchant pellets, the EBITDA per ton is roughly 700. So this is a clear advantage for them because of high grade and fully high grade pellets and fully captive iron ore mine. Now, in terms of capacity expansion to drive robust growth over the next 3 years, what they're doing is they're increasing mining expansion, awaiting the environmental clearance, crushing and benefaction. They are adding capacity so that to again they are waiting uh, environmental clearance. Now, how this will benefit is this plant will process the low-grade iron ore and convert it into high-grade iron ore. So again, increases the opportunity for them in terms of sales, etc. Then they are increasing their pallet capacity, and they place order for equipment already. And integrated steel plant they are planning to do, waiting for environmental clearance. So once they do it, uh, this will add on to their earnings, etc. Now, presently, because of captive iron ore, they have huge advantage because if you see market price is 6,200 rupees per ton, while their cost comes to 2,800. So this is the spread they get. EBITDA per ton due to rising contribution from pellet and forward integration to flat steel in later years. by FY30, their EBITDA is expected to nearly double from present levels, and the margin EBITDA per ton uh, will go up to around 8,300, which will drive in profits in a big way. As it is, the EBITDA per ton is increasing now because of more efficiencies. So the as EBITDA goes up and they become more and more efficient. So revenues are expected to grow 14%, EBITDA to grow 30% over the next 3 years. FY25 is the present year is expected to be flat, but EBITDA will be still higher because of better efficiencies. This is because 67% of the captive power to become green from renewable sources is helping them reduce carbon emissions and reducing their cost, and margins are improving. So if you see FY23, they did 19.7. Now FY24 onwards, the margins are improving and they will improve substantially to 36.5% by FY27. Now let's see their earnings. The revenue will remain generally flat over FY25, but EBITDA margins will improve, which will improve the profit, and rest all parameters are improving. But FY26 onwards, every year they are likely to get around 20% revenue growth and EBITDA growth of around 30% plus, and PAT will likely to grow at around 40% CAGR, and FY26 EPS of around 124. So with improvement in ROE, ROC, etc., they are having a valuation of 5 times EV/EBITDA, which is very positive and much, much lower than the peers. So if you see the valuations of their peers, Tata Steel, JSW Steel, SAIL, Lloyds Metals and Energy, bigger than them, NMDC, Sada Energy, and Godawari Power. So if you see their valuation wise, they are at much cheaper valuations, even in FY24 wise and for FY26 also. So there is a lot of scope for increase in prices from present level. Let's see the chart. It had gone up to around 1200 level, and then from there it is corrected and is now below 100 EMA. And here, if you see, 20 EMA has crossed the 50 EMA. So it is in a kind of a negative territory, and there is sentiment is poor, but it will likely to bounce back. So anything closer to 200 EMA is a big buying opportunity here. So the key issue for them is increase pellet capacity, premium on pellets. They are selling high grade pellets, which have got 63 to 67% iron content, no royalty, captive iron ore and solar power plants. They are establishing a 2 million steel plant, which will increase EBITDA by 2.5 to 3x and EBITDA per ton by 2x. Attractive prices right now. So it is at 5 times EV to EBITDA. Hence, it is at much lower levels than peers. And demand for steel is expected to remain strong. Now, China imports high quantity of iron ore from India, which is basically low-grade iron ore, which it converts it into steel and dumps it in global steel market. So right now also there is a lot of dumping which is taking place. So the demand for steel is expected to remain soft in this year. Captive mines of theirs have a lease of 50 to 36 years, so that has long-term visibility. It can go to 6 times EV/EBITDA very easily, so which should be closer to around 1100 to 1200 level. Keep this stock under watch. The last stock today is GMR Airports. The value creation at any airport is sum of aero business, which is regulated and subsidized, from non-aero business, which is unregulated. Specialists pay rent or revenue share to the airports and city side development, which is the land near the airport area, which they hold and which they develop for creating various assets. GMR is undergoing merger with its subsidiary, and it will be issuing 341 crore new equity shares to shareholders of the listed entity and optionally convertible preference shares, which upon conversion will translate into 260.5 crore shares and existing FCCB. FCCB is foreign currency convertible bond, is get converted to 111.2 crore equity shares. So basically it implies that they had debt which they are not able to pay back, and now that is converting it into equity. So the equity quantum of equity is rising. Currently, they have 603.5 crore outstanding shares. Post-merger, they will be having 1,060 shares, 1,060 crore equity shares. And after conversion, there would be 1,320 crore equity shares. So it implies they have an equity base of they will have equity base post FY26 of 1,320 crore with the face value at 1 right now. So they must make a profit of at least 1,320 crore to get a EPS of 1. So right now the profit is much below 1,320. So the EPS earnings per share is in paisa. Traffic at airport grew by 7% year on year at Delhi Airport, 18 million passengers, 10% year on year at Hyderabad Airport, 6 million passengers, and 18% year on year at Mopa Airport, which is in North uh, Goa. This is Manohar International Airport, and this is a newly made airport. So the passengers were 1 million there. Overall, passengers grew 7% year on year to 32 million, that is 3.2 crore. New tariff order at Delhi Airport to aid in improving aero charges on account of new interpretation of concession by April 30 and commissioning of new terminals at Delhi Airport. Also expect rise in traffic and improvement in non-aero revenues. So if you see their consolidated financials, the gross revenue year on year for this quarter was up 19%, roughly 2,400 crores. And EBITDA was also up 19%. Margin slightly declined, but was up Q on Q. Interest and finance charges increased 58%, much higher, and depreciation was also higher because there were a lot of infrastructure. So the profit before tax was negative, and the losses have increased by 2913%. So the PBT was also negative, and PAT was also negative. So the overall earnings were negative. They have been the losses have increased if you see over the last 2 years by 212%. The main reason is because over the last FY23 over FY24, the interest and finance charges have increased by 41% and depreciation has also increased by 41%. So it leads to losses. Now coming to airport wise, for Delhi Airport, the revenue was up 7%. The non-aero business was the best performing and earned maximum earnings, which was 770 crore, which is their duty-free shop. EBITDA margins declined slightly, but were up Q on Q. Interest and finance charges were up 93%. So that took care of the profits, and that's why it made a loss. Similarly with depreciation. Hyderabad Airport, the revenue was up 22%, but margins declined. Interest and finance charges were up 69%, though it was profitable. But profit was only up 31%. But the PBT had declined. The last time they paid higher taxes, this time the taxes were low, so the profit after tax was. Passenger count was around 10% higher. Now, Goa Airport is a new airport, so it is increasing 169% year-on-year growth. Interest and finance charges were higher. PBT declined, but it was still better. The losses were lesser because the interest and finance charges and depreciation is not yet fully kicking in. They're still lesser. Subsequently, they will be higher. They're getting around 1 million passengers, basically domestic passengers. Now coming to their profit and loss for future, they're expected to grow net sales by around 15 to 20% over the next 2-3 years. And EBITDA is also likely to grow. Interest expenditure is likely to reach around 3,000 crore every year. So it is likely to get stabilized. So it is likely to become PBT positive in FY26 in case there is no additional loan or additional infrastructure which is created or it doesn't get into another airport. Net income, it is make some 360 crore rupees of profit in FY26. So remember the number of shares they're going to have is 1,300 odd crores. So the EPS would be in paisa. Cash flows are expected to be positive, so which is okay. Cash flow from all operating, financing, and investment activities are likely to be positive. So that way, there is no cash flow problem. Share capital is increasing, as I have told you, and it was net worth was negative uh, in the last 3 years. Net worth is assets minus liabilities, so that means liabilities were more and assets were lesser. Key ratios, if you can't, we can't value it on PE. So EV EBITDA wise, it is expensive. It's still at 30 times for FY26 earnings, but it is becoming cheaper now as the debt is reducing and revenues are improving. Price to sales wise, it is at 11 times, which is expensive. Other ratios and profitability ratios are now slowly improving. Uh, One of the SOTP based valuations given by ICICI Securities, considering the value in Delhi, Hyderabad, and Goa Airport and other group entities, it can be easily valued at around 85 rupees per share. So it is slightly overvalued. So if you see the chart, uh, it has gone up to 100 and faced supply here, and it corrected from there. Number of times it has tried to test that 100 odd level and has corrected. So it is better to buy it at some dip, a sizable dip to around 84, 85 level or the 200 EMA, where it had bounced back also from there in June. The good part is that the strategic investor now is now becoming an investor in the company. That is the Grupo ADP, and they will hold shares. And if existing FCCB is being converted to equity, so the debt will reduce. Trigger is improved sales in duty frees in Delhi and Hyderabad, and improvement in non-aero revenue, that is the real estate closer to the airports. Risk is competition from Jewar Airport and slow rise in traffic. So I have finished. We will take question now.